Investment in long-lived assets, such as property, plant, and equipment, are important elements in many companies' statement of financial position. Along with research and development, these investments are driving the force for many companies in generating cash flow. Property, plant, and equipment information reported on statement of financial position directly affect their total assets, depreciation expense, cash flows, and net income. As the result, companies are careful regarding their spending level for capital expenditures or capex. To determine the proper level of capital expenditures in many companies is challenging. Too much spending can lead into decreasing cash flow, but too little spending will cause loss in competitive position and diminishing pricing power. The adjacent graph shows that the global capital expenditures are highly variable and tend to follow the trends in revenue and EBITDA growth. Even in good times, the issues related to capital expenditures are complex. There are the challenges for managers in determining the proper level of capital expenditures. The first one is spending volume. How much should be spent? The second one is capital allocation. What should it be spent on? And the last one is project execution. How does spending transform into real returns? Answers to these questions are not easy, and failure to answer them correctly can lead to a loss of profitability. It also follows that these issues are of extreme interest to users of financial statement. Relationship between capital expenditures to sale and capital expenditures to depreciation, as well as free cash flow, provide insight into the underlying financial flexibility of a company. Many companies use assets of a durable nature, such as assets called property, plant, and equipment. Other terms commonly used are plant assets and fixed assets. Property, plant, and equipment is defined as a tangible assets for production or supply of goods and services, rental to others, or administrative purpose, and expected to be used during more than one period. Property, plant, and equipment therefore includes land, building structures, equipment like machinery, furniture, and tools. There are three major characteristics of PPE. The first one, they are equipped for use in operations and not for resales. Only assets used in normal business operation are classified as PPE. And the second one is long-term in nature and usually depreciated. PPE yield service over a number of years. Company allocate the cost of investment in these assets to future period through periodic depreciation charts. The exception is land, which is depreciated only if a material decrease in value occurs, such as loss in fertility of agricultural land because of poor crop rotation, drought, or oil erosion. And the third one is possess physical substance. PPE are tangible assets characterized by physical existence or substance. This differentiates them from intangible assets such as patents or copyrights. But unlike raw materials, PPE doesn't physically become part of a product held for sale. The next one, we are talking about acquisition of property, plant, and equipment. Most companies use historical cost as the basis for valuing property, plants, and equipment. Historical cost is measures the cash or cash equivalent price of obtaining the assets and bringing it to the location and condition necessary for its intended use. A company recognizes PPE when the cost of assets can be measured reliably and it's probable that the company will obtain future economic benefit. And in general, companies report of the following costs of part of PPE are: the first one, purchase price. It's including the import duties and non-refundable purchase tax, less with trade discount and rebates. And for the second one is cost attribute to bringing the assets to the location and condition necessary for it to be used in a manner intended by the company. It's including the delivery cost, and it capitalizes the cost of purchase. Company value PPE in subsequent period using either the cost method or fair value or revaluation method. Company can apply cost or fair value method to all items of the PPE or to a single class or classes of PPE. And most company use the cost method because it's less expensive to use because the cost of an appraiser is not needed. In addition, the revaluation or fair value method generally leads to higher asset values, which means that companies report higher depreciation expense and lower net income. The next one, we are talking about cost method. The first one, we have cost of land. It's all expenditures made to acquire the land and ready it for use. It's including the purchase price, the closing costs such as title to the land, attorney's fees, and recording fees. And the third one, costs incurred in getting the land in condition for its intended use, such as grading, filling, joining, and clearing. The fourth one is assumption of any lands, mortgage, or encumbrance or on the property. And the last one is any additional land improvement that have an indefinite life. When a company purchases land for the purpose of constructing a building, it considers all costs incurred up to the excavation for the new building as land cost. And removing old buildings, clearing and grading is included in land cost, and any process from demolition reduces the land cost. When a company purchases land, it may assume certain obligation on the land, such as back taxes or liens. In such situation, the cost of land is the cash paid for it plus the encumbrance. And it might also incur special assessment for local improvements such as pavements, streetlights, sewers, and drainage system. It should charge this cost to the land account because they are relatively permanent in nature. After installation, they are maintained by the local governments, and the company should charge any permanent improvements it makes, such as landscaping, to the land account, and it records separately in any improvement with limited life, such as private driveways, walks, fence, and parking lots, to the land improvements account. These costs are depreciated over their estimated life. Land is actually part of property, plant, and equipment. If the mere purpose of acquiring and holding land is speculative, a company more appropriately classifies the land as an investment. If real estate concern holds the land for resale, it should classify the land as inventory. And the next one is the cost of buildings. The cost of buildings should include all expenditures related to their acquisition or construction. This cost includes the materials, labor and overhead costs incurred during the construction, and professional fees and building permits. Companies consider all costs incurred from excavation to completion as part of the building costs. If a company purchases land with an old building on it, then the cost of demolition less its residual value is a cost of getting the land ready for its intended use and relate to the land rather than to the new building. In other words, all costs of getting an asset ready for intended use are costs of that asset. The next one is cost of equipment. Equipment accounting includes delivery equipment, office equipment, machinery, furniture and fixtures, furnishing, factory equipment, and similar fixed assets. The costs of such assets include the purchase price, freight and handling charges incurred, insurance on the equipment while in transit, cost of special foundation if required, assembling and installation costs, and cost of conducting trial runs. Thus, cost thus includes all expenditures incurred in acquiring the equipment and preparing it for use. The last cost method we're gonna discuss is self-constructed assets. It's when companies construct their own assets. To determine the cost of such machinery or and other fixed asset can be a problem. Without a purchase price or contract price, the company must allocate costs and expenses to arrive at the cost of the self-constructed assets. It's including the material cost, direct labor cost, and overhead or burden cost. And there are two ways for a company to handle the overhead. The first one is assign no fixed overhead to the cost of the constructed assets. The main argument for this treatment is that overhead is generally fixed in nature. As a result, this approach assumes that the company will have the same cost regardless of whether or not it constructs the assets. Therefore, to charge a portion of the overhead cost to the equipment will normally reduce current expense and consequently overstate income of the current period. The company would assign the cost of the constructed assets variable overhead cost that increase as a result of the construction. And the second one is assign a portion overhead of all overhead to the construction process or called full costing approach. It's assumed that the cost attached to all products and assets manufactured or constructed. Under this approach, a company assigns a portion of all overhead to the construction process as it would to normal production. Advocates say that failure to allocate overhead costs understate the initial cost of the asset and result in an inaccurate future allocation. Companies should assign to the asset a pro rata portion of the fixed overhead to determine its cost. Companies use this treatment extensively because many believe that results in a better matching of costs with revenues. Abnormal amount of wasted material, labor, or other sources should not be added to the cost of the asset. If the allocated overhead result in recording construction costs in excess the cost that an outside independent producer would charge, the company should record the excess overhead as a period loss rather than capitalize it. This avoids capitalizing the asset at more than its fair value. Under no circumstances would a company record a profit on self-construction. The next one we are talking about borrowing costs during the construction. The proper accounting for borrowing costs has been a long-standing controversy. There are three approaches for interest incurred in financing the construction of PPE. The first one, capitalize no borrowing cost during construction. Under this approach, interest is considered as a cost of financing and not a cost of construction. Some contend that if a company had used equity financing rather than debt, it would not incur this cost. The main argument against this approach is that the use of cash, whether it sorts, has an associated implicit interest cost which should not be ignored. The second one is charge construction with all borrowing costs of funds employed, whether identifiable or not. This method maintains that the cost of construction should include the cost of financing, whether by cash, debt, or equity. Its advocates say that all costs necessary to get an asset ready for its intended use, including borrowing costs, are part of the asset's cost. Interest, whether actual or imputed, is a cost, just as are labor and materials. A major criticism of this approach is that imputing the cost of equity capital is subjective and outside the framework of an historical cost system. And the last one is capitalize only the actual borrowing cost incurred during construction. This approach agrees in part with the logic of the second approach, that interest is just as much as cost as are labor and materials. But this approach capitalizes only borrowing costs incurred through debt financing. Under this approach, a company that uses debt financing have will have an asset of higher cost than a company that uses equity financing. Some consider this approach satisfactory because they believe the cost of an asset should be the same whether it's financed with cash, debt, or equity. IFRS require the third approach, which is capitalizing actual interest with modification. This method follows the concept that the historical cost of acquiring an asset includes all costs, including borrowing costs, incurred to bring the asset to the condition and location necessary for its intended use. The rationale for this approach is that during construction, the asset is not generating revenues. Therefore, a company should defer or capitalize borrowing costs. Once construction is complete, a company can utilize the assets in its operation. At this point, the company should report borrowing as an expense in the determination of net income. It follows that the company should expense any borrowing costs incurred in purchasing an asset that's ready for its intended use.
Hello guys, my name is Jayanti Hadiati with my last three digits of student ID R084. Alright, now let me explain to you through the underlying concept of borrowing cost capitalization, which is the first one is we're gonna talk about the purpose. The idea here is to allocate the borrowing cost or interest as part of the cost of assets. So instead of the recognition interest as an expense immediately, we capitalize it into the assets. Why we capitalize into the assets? Because the assets is not yet generating revenue during the construction. So the cost should be matched with the future of the benefits it will be provide. So now we're gonna moving about the key point, which is the first one is qualifying assets. These are assets that take a long time to become ready for use or sale. For the example is building. So the factories, also the machinery, property development, or even the ships. On the other hand, assets that are ready for immediate to use or inventory that turns over quickly don't qualify. So next we have to talk about the capitalization period, which is this period begins only where the three conditions are met, which is the first one is expenditures have been incurred, the second one is the construction is in progress, and the third one is the interest costs are being incurred. So capitalization continues as long as these conditions exist, and it ends when the asset is ready for use. And the last one, it's about the amount to capitalize, which is the amount depends on how the project is financed. There are three possibilities. The first one is the specific debts, where the borrowing is directly tied into the project. And then the second one is the general debt, where a financing comes from overall the company funds or a combination of the both. So each scenario affects how to much interest in the capitalized into the assets. So now let's move to the how we calculate the amount of borrowing cost to capitalize using two approaches. The first one is specific debt and then the second one is general debt. We can run into the specific debt first, which is in this case, the borrowing is directly related to the construction project. We are given a loan of the 1,500,000 and then give interest 15% and investment income is 60,000. So first we calculate the borrowing cost, 1,500,000 multiplied by 15%. It's equal to 225,000, and then we subtract the investment income, 225,000 minus 60,000 equals to the 165,000. So the amount of borrowing costs capitalized is 165,000. This amount will be added to the building cost while the investment income is deducted from the capitalizations. So the second one is general debt. Here's the project is financed using overall company borrowings. We have two tabs. The first one is 10% of 1 million and then the second one is 12% of 1,500,000. So the step one is we calculate the average of carrying amount. We calculate the weighted expenditures based on the time. For the first is January, which is 210,000 for 12 months, and then 200 it's become 210,000. And then the second one is March, the 300,000 for 10 months, and then it becomes to 250,000. And then the next one is May, which is 540,000 for 8 months. It will become the 360,000. So the last one is December, 450,000 for 0 months. So it means 0, and then the total of average carrying amount is 820,000. And then the step 2 is capitalization of rate. We compute the weighted average interest rate. So 10% weighted by 1 million divided by 2,500,000. Then plus 12% weighted by 1,500,000 divided by 2,500,000. This gives us the 11.2%. So the step 3 is capitalized interest. Now we multiply the 820,000 multiplied by 11.2%, and then it will become 91,840. So the important rule in here is the capitalization amount must not exceed actual interest. So the total of actual interest is 280,000, since the 91,840 is lower. So that is the amount that we use. So the next one is about the journal entry. To record this, it's the debit is holding, which is 91,840, and then debit again, it's interest expense for 188,160, and then the credit, the account is cash for 280,000. So the next we're going to talk about the mixed debt scenario, where the financing comes both from the specific debt and also general debt. So for the first step, we calculate the specific portion, which is here in this case is the example of the nominal is 750,000 multiplied by 15%. It gives us the 112,500. Then we subtract the investment income with the 40,000. So the total capitalized from the specific debt is 72,500. So the second step is general portion, where we have given a capitalization rate of the 11.5%. And then the third step is allocation of expenditures. We allocate the construction expenditures between the specific and general debt. So for the first one is January, which is the nominal is 2,100 to out from the specific. And then the second one is March 1st, which is the nominal is 300,000 to out from the specific. And then the third one is May 1st. The nominal is 540,000 to 240,000 from the specific and to 300,000 from the general. And then the last one is the December, with the nominal is 450,000 to out from the general. So the total of the specific is 750,000. Also, the total of general is 750,000. And then the next step is the calculation of the general debt. We multiply the average carrying amount by the rate. So the result is 23,000. And then the next step is total capitalized borrowing cost. Now we combine the specific with the nominal is 72,500, and then the next is the general debt, which is the nominal is 23,000. So the total capitalization is 95,500. And then disclosure of the requirement, the companies must just disclose. So the amount of the borrowing cost capitalized and then the capitalization rate are used. So the next one is about the valuation of property, plant, and equipment. The principle here is the example. Use the most of reliable value of the fair, or we can say in correct and clearly, it's use the most reliable fair value. This ensures the assets is recorded at a realistic and objective amount. So for the next is the cash discount. There are two approaches. The first one is the preferred approach. Treat the discount as a reduction in the price. And then the second one is the alternative approach. Discount is not always treated as a reduction. So for the next is deferred payment contracts. For deferred payments, we use the present value. So for the example of the calculations is 20,000 multiplied by 3.79079. Give us the 75,816. And then the journal, it's the early journal first, which is in the debit is equipment with the nominal is 75,816, and then the credit, the nominal is 70. The credit, the account is payable, which is the nominal is 75,816, and then in the year one, the journal it's on the debit is interest expense, which is the nominal is 7,582, and then in the debit too, it's the account is not payable, which is the nominal is 12,418, and then in the credit, the account is the cash with the amount is 20,000, and then in the year two, the journal in the debit is interest expense with the nominal is 6,340, and then with the debit account is not payable with the nominal is 13,660. Also in the credit side with the nominal is 20,000. Finally, the last slide for my part, let's move to the lump sum purchases. This occurs when a company purchases multiple of assets together for a single price instead of buying them separately. So for the step one is understand the data that already given. We are given three assets. For the first asset is inventory, which is the nominal is in the book value of 30,000 and a fair value of 25,000. And then the second asset is land with an book value of the 20,000 and a fair value of 25,000. And then the third asset is building with a book value of 35,000 and a fair value of 50,000. So in the total, in book value is 85,000. Meanwhile, in the fair value is 100,000. In the key principle of the lump sum purchases, we do not use the book value. Instead, we allocate the total of purchase price based on the relative fair value, because fair value reflects the true economics worth of the each asset. And then the second step is the allocation based on the fair value. The total purchase price is 80,000. Now we allocate the proportionally. So for the first assets is inventory, which is the nominal. Within the nominal is 25,000 divided by 100,000 multiplied by 80,000. This gives us the nominal of 20,000. And then the second asset is land. Within the nominal of 25,000 divided by 100,000 multiplied by 80,000. This also gives us the nominal of 20,000. And then the third one of the assets is building within the nominal of 50,000 divided by 100,000 multiplied by 80,000. This gives us the nominal of the 40,000. So for the final allocations, which is the inventory, it's 20,000. Meanwhile, in the land assets is 20,000. And then the building, it's 40,000.
Uh, so in this occasion, I will present to you some materials about the first is the issuance of shares. The issuance of shares is the when companies acquire property by issuing securities such as ordinary shares, the pair or stated value of such shares fails to properly measure the property cost. If trading of the shares is active, the market price of the shares is a fair indication of the cost of the property acquired. The shares are a good measure of the current cash equivalent price. And if the company cannot determine the fair value of the ordinary shares change based on the market price, it might estimate the fair value of the property. It then uses the value of the property as the basis for recording the assets and issuance of the ordinary shares. Next is the exchange of non-monetary assets. The ordinarily companies account for the exchange of non-monetary assets on the basis of the fair value of the assets given up or the fair value of the assets are received, whichever is clearly more evident. Thus, the companies should recognize immediately any gains or losses on the exchange. The rationale for immediate recognition is that most transactions have commercial substance and therefore gains and losses should be recognized. Therefore, the fair value is the basis for measuring an asset acquired in a non-monetary exchange if the transaction has commercial commercial substance. An exchange has commercial substance if the future class. An exchange has commercial substance if the future cash flows change as a result of the transactions. That is, if the two parties' economic positions change, the transaction has commercial substance. Then is the exchange loss situation that has commercial substance. When a company exchanges non-monetary assets and a loss result, the company recognizes the loss if the exchange has commercial substance. The That is, the company should not value assets at more than their cash equivalent price. If the loss were deferred, the assets would be overstated. Then, if the exchange gain situation has commercial substance. In any situation, consider the situation in which a non-monetary exchange has commercial substance and again is realized. In such a case, a company usually records the cost of a non-monetary assets acquired in exchange for another non-monetary assets at the fair value of the assets given up and immediately recognizes again. The company should use the fair value of the assets received only if it is more clear evidence than the fair value of the assets given up. And next is the lax commercial substance. In any case, compute the total gain or loss on the transaction. This amount that is has computed is equal to the difference between the fair value of the assets given up and the book value of the assets given up. Therefore, there is two conditions. The first, if the exchange has commercial substance, the recognize the entire gain or loss. And the second, if the exchange lacks commercial substance, means that there is no gain or loss is recognized. Next is the government grants. Government grants are assistance received from a government in the form of transfers of resources to a company in return for past or future compliance with certain conditions relating to the operating activities of the company. In other words, a government grant is some of type of assets such as cash, securities, property, plant, and equipment, or use of facilities provided as a subsidy to a company. A government grant also occurs when debt is forgiven or borrowings are provided to the company at a below market interest rate. Next is the accounting approaches. We have two accounting approaches, that is capital equity, capital or equity approach, and the income approach. But in the IFRS, the approaches that is approved to be used is the income approach.
So when a company contributes a non-monetary asset, it should record the amount of the donation as an expense at the fair value of the donated asset. And if a difference exists between the fair value of the assets and its book value, the company should recognize a gain or loss. To illustrate, there is client industry donates land to the city of Sao Paulo, Brazil for a city park, and the land cost is $80,000, has a fair value of $110,000. And client industry will record the donation like this: contribution expense $110,000 in debit side, and land $80,000 in credit side, and gain on disposal of land $30,000 in credit side. And then for the next, we have cost subsequent to acquisition. So a company recognizes cost subsequent to acquisition as an asset when the cost can be measured reliably and it is probable that the company will obtain future economic benefits. So for the next one, we have four major types of expenditure. The first one is addition. So addition is when companies capitalize any addition to planned assets because a new asset is created. And for the example is the additions of a wing to a hospital or of an air conditioning system to an office increases the service potential of that facility. And companies should capitalize such expenditures and record them in future periods when revenues are recognized. And for the second one is improvement and replacement. So companies substitute one asset for another through improvements and replacement. And what exactly the difference between improvement and replacement? So improvement itself is the substitution of a better asset for the one currently used, like a concrete floor for a wooden floor, and while the replacement is the substitution of a similar asset, like a wooden floor for a wooden floor. And if the expenditure increases the future service potential of the asset, a company should capitalize it. Like the company should simply remove the cost of the old asset and related depreciation and recognize a loss, if any. It should then add the cost of the new substituted asset. And for the third one, we have rearrangement and reorganization. So is like a company might incur rearrangement or reorganization costs for some of its assets. And did you know that IFRS indicates that the recognition of cases once the asset is in the location and condition necessary to begin operations as management intended. As a result, the cost of reorganizing or rearranging Existing property, plant, and equipment are not capitalized but are expensed as incurred. And for the last one is repairs. So repairs is divided by two categories. The first one is ordinary repairs. So the ordinary repairs is aims to maintain plant asset in operating condition. It charges ordinary repair to an expense account in the period incurred on the basis that it is the primary period benefited. Maintenance charges that occur regularly include replacing minor parts, lubricating and adjusting equipment, repainting and cleaning. A company treats this as ordinary operating expense, while the major repair, such as overhaul, when the major repair occurs, several periods will benefit. A company should generally handle this cost as an improvement or replacement. The next one we have disposition of property, plant, and equipment. So a company like Nokia may retire plant asset voluntarily or dispose of them by sale, exchange, involuntary conversion, or abandonment. Regardless of the type of disposal, the depreciation must be taken up to the date of disposition. Then Nokia should remove all accounts related to the retired assets. Generally, the book value of the specific plant asset does not equal its disposal value. And the reason is depreciation is an estimate of cost allocation and not a process of valuation. The gain or loss is really correction of net income for the years during which Nokia used the fixed asset. And Nokia should report gains or losses on the disposal of plant asset in the income statement along with other items from customer business activity. Also, Nokia should report any gain or loss from disposal of a business component with the related result of discontinued operation. And then for the next, we have involuntary conversion. So sometimes an asset services is terminated through some type of involuntary conversion, such as fire, flood, theft, or condemnation. And to illustrate, Camel Transport had a manufacturing plant located on company property that stood directly in the path of a tornado. As a result of the tornado, which occurred on May 16, 2022, the plant was completely destroyed. Camel was eventually able to reach a settlement with its insurance company for the full fair value of the plant. The settlement was reached on March 18, 2023 at the time of the tornado. The building had a carrying value for like 3 million $500,000. This is the original cost of 6 million $6 million less accumulated depreciation of $2,500,000. The amount of the settlement with this insurance company was $5 million. Camel made the following entries like the loss from tornado in May 16, 2022 in the debit side as much $3,500,000 and the accumulated depreciation buildings to $2,500,000 in the debit side also, and the buildings $6 million in the credit side. And on the March 18, 2023, the Camel made following entries: cash $5 million in the debit side and gain from insurance settlement $5 million in credit side. The next one is sale of planned assets. So companies record depreciation for the period of time between the date of the last depreciation entry and the date of sale. And to illustrate, assume that parent group recorded depreciation on a machine costing 18,000 euro for 9 years at the rate of 1,200 euro per year. And if it sells the machine in the middle of the 10 year for 2,000 euro, parent records the depreciation to the date of sale as I already put the first example. The depreciation expense 1,200 euro multiple with the 1 per 2, and it result 600 in debit side, and then accumulated depreciation machinery 600 in the credit side. And the entry for the sale of the asset is the cash 7,000 euro in the debit side, and accumulated depreciation machinery 1,200 euro multiple with 9 plus with 600 euro, resulting 11,400 in the debit side, and the machinery is 18,000 in credit side, and gain on disposal of machinery 400 in credit side too. And the book value of the machinery at the time of the sale is 6,600 euro, which is it is from 18,000 euro minus or deducted with the 11,400 euro, because the machinery sold for a 7,000 euro. The amount of the gain on the sale is 400 euro. It is from the 7,000 euro minus or deduct with 6,600 euro.